Zero DTEs have exploded in popularity over the past year, and I've even seen some market measure studies done on them, and I kind of wanted to get my hands on them and, at least execute a trade because I never have before on a zero DTE option. So I reached out to Anton from the research team to see if he's had experience with these, what he knows about them, what we should keep in mind, and how we should approach them. So Anton, ever since zero DTEs were introduced to the market on a Monday through Friday basis, they seem pretty popular, especially just looking at all the chatter online and what people are talking about. So why do you think zero DTEs are so popular and such a hot topic?
Yeah, it's a good question. So I think the biggest draw to them comes from the potential to buy an option, which is already, traditionally speaking, could be used as a high risk, high return investment, right? And now you have them every single day. So you're able to buy an option for very, very cheap, basically. And if you get the move you want in the market on that day, the return on that option could be much bigger than if you were trading options further out. And I think the allure of kind of turning a little bit of money into a lot of money very quickly is probably the biggest reason I think they've exploded in popularity.
So what are some of the main things that traders should be paying attention to when wanting to get into the zero DTE market?
The biggest thing, first and foremost, is the size of your position. Okay? That is, and if you're talking about from just putting a trade on, right? The size of your position matters probably more in the zero DT than any other cycle, because it may seem like you're not putting up all that much when you trade them, because remember, they're cheaper contracts. You're like, well, I can just do more of these instead of doing one contract in the 7-day cycle. Well, I can do 5 in the zero DTs. Well, when you increase the size, remember that you're actually trading the same underlying, right? And you're trading it with a leverage of 5-to-1 in the zero DTs versus just the leverage of 1-to-1 in the 7-day cycle. Even though the contracts are cheaper, the leverage is significantly greater. So that means that whether you win or lose is going to be a much, much bigger amount than you probably even realized before you put the trade on, just because of the compressed time. Now, when you're looking at an underlying trade, one group of people trades the zero DTs like a range-bound play. In other words, let's say you have the S&P 500 opens and you know there's going to be, the Fed is going to come out with their announcement today. Those zero DT options would be pretty expensive because there's a huge event coming. Well, you could trade them. One way to trade them is to say, okay, you know what, I think that those options or the move from the Fed is not going to move the market all that much. We could do something like a butterfly. That butterfly is going to be very, very, very cheap because volatility is so high on that day. And your goal is to not have the market move, right? Because if it doesn't move, your butterfly actually increases in value, sell it. Now, the other way to trade them is if you're a guy or a girl looking for a huge move in the market. You want to make that 5-to-1, 10-to-1 return, and you're thinking there's going to be a huge afternoon move in one way or another. Well, then you may try to go to the higher implied volatility underlyings, just because those have even more of an amplified move. But remember, then you have to acknowledge the fact that you're taking a shot in that case, and most of the time you're going to lose. But once in a while, it is kind of fun. You have a huge move at the end of a week on a Friday, and you want to buy some Tesla calls because you think there's going to be, a big move in Tesla. Well, there are a lot of swings in those high volatility stocks, and this coupled with the zero DT strategies can really, really make for a nice move. But most of the time, if you're a consistent trader, you're probably going to lean towards the first type of way of trading and trade like the ranges inside the market on a day like the Fed, or just a random day where there seems to be more volatility.
So now, what kind of zero DTE trader am I? Well, I've never actually really traded zero DTEs, so I don't really have a style that I typically like to trade, but I'm gonna go with range bound this time just because with CPI data being released, sometimes we'll get some choppy action in the market, and it would be pretty cool to take advantage of some of that theta decay. So we're gonna go with the Iron Condor, the range bound, the more neutral strategy. As for position size, I'm looking to put on the smallest position that I can, and this is one of the first times that I'm trading a zero DTE, so we're gonna make sure we're implementing risk management first and foremost. Why wouldn't somebody just, size up on a later date contract if they wanted to make more money?
It really comes down to capital allocation, right? Because if you can make 10-to-1 with a zero DT option, okay, you won't. It's very, very rare that you'll be able to make 10-to-1 on a longer dated option on that same day, right? So zero DT's options are kind of compressed. So everything you could do on a longer dated trade, you do on one specific day. Right, and you could theoretically size up on a longer dated contract, but in order to get that 10-to-1 return, you'd have to probably wait a few days for it to materialize, and not to mention the fact that a longer dated contract costs more per contract, so you'd be outlaying a large proportion of capital. Those two things combined make the zero DTs a little bit more attractive because you could still make theoretically the 10-to-1, but you can put up less capital, and you get the move instantaneously, ideally, right? This is all in an ideal situation.
Right.
But of course, most of that obviously exposes you to losing most of the time if you're trying to play for a 10-1 move every single day.
When it comes down to these zero DTEs and someone wanted to take part in it, would it be selling contracts, buying contracts? What would be the difference on, getting involved with zero DTEs, buying versus selling them?
Yeah, that's a really good question. So we've done some research, and I think the main takeaways from the research is because of the way capital is used in the zero DTE options, you can't trade the same way that we would traditionally trade a Tasty in a longer dated contract. What that means is whenever we trade like 45-day trades, 30-day trades, we tend to trade them short and undefined risk. One of the ways we figured it out is, hey, you know what, if you define your risk on these contracts, even if they're $10 away, which is a huge move for a 0-day contract, but let's say you do it and you pay a penny for those options,
Right.
2 pennies, you're going to reduce the capital usage by like 80 to 90%, and even greater in some cases. And you're not taking any more risk, you're just reducing the capital you use. That makes sense?
So it just makes more sense to use defined risk in zero DTEs.
That's right. And not just and that's only from the short premium. Like let's say you want to sell a strangle, you would even still use defined risk to cap those wings and call the synthetic strangle. Now,
okay, so debit or credit defined risk.
That's right. So now let's say you wanted to do like a debit spread. You wanted to do a long put spread. Well, here's the thing. In a zero DTE contract, if you buy those long options, the decay happens very, very quickly. Right. So in order to offset some of that decay, you could sell an out of the money put, but because the contracts get so much cheaper, so much quicker as you go out of the money in the zero DTs, you don't have to kind of take away from your overall profit potential when you do the spread. So whether you're going long or short premium, defining the risk actually makes a lot more sense in the zero DT than it does in the 45-day cycle.
So I'm going to be selling an Iron Condor because I'm going to be going for more of that range bound play. I'm going to try and throw an Iron Condor around that stock price and see if Theta Decay can do its job throughout the day and see what we end up with. And when it comes down to, let's say, order entry, are we still looking to collect around a third of the width of the strikes minimum or as much as possible? Or what is that situation looking for when we're going to find risk?
Yeah, so whenever we trade defined risk on a zero DT, you could do it one of two ways. You could do it with a butterfly. Basically, you put a butterfly in the morning, and at some point in the next few hours, if the expected move until the close decreases, that butterfly is actually going to go up in value. You can sell it, right? And in that case, a typical thing we've been doing is if you're trading the SPX, you sell 2 of the at the money calls, and then you buy one call $30 lower and $30 higher. So you're basically your width is about $30 on that butterfly to each side, and ideally you'd look to pay between $5 and $10 for that, right? And then close it at about 25 to 30% of the amount you paid, right? So you're looking for about 25 to 30% of debit paid if you're trading a butterfly. Now, if you're trading an Iron Condor, it's basically the reverse, right? You'd be basically collecting approximately 1/3 of the width of the strikes, right? That doesn't change. Now, you could go half of the width of the strikes, if you want to be a little bit more aggressive, but still the profit target you're looking to take is about 25 to 30%. If you're selling the strategy, you're going to look to buy cheaper by 25%. If you're buying something, you want to look to sell 25% higher.
Jumping into the Tasty Trade platform, we're going to be checking out SPY and we're going to be trading the 0 days till expiration options contract. I'm going to throw on an Iron Condor. I was thinking about getting a little directional, but this week in the market, there's CPI data being released, and usually the day before the market will have some kind of sideways behavior or some sideways price action. So we'll see if we get that today. So I want to just lock in an Iron Condor around the expected move, and I'll see how much we can collect. Let me pull this out a little more. I collect 40 cents of credit on a $1 wide Iron Condor. That's a really small position. So I think we're going to roll with this. We're near the 1 standard deviation, not exactly on it, but we're near the 1 standard deviation for today's move. That's as low as I'm going to go. And we'll see if we can get that Iron Condor locked in, and then, okay, there we go. We got filled at 37 cents on SPY on an Iron Condor, so we'll see by the end of the day if we can sit within 411 because that's the call that I sold, and if we can sit above 408 because that is the put that I sold. So we'll see what happens throughout the day, and we'll give you an update whenever that happens. It just feels like there's this strategy you can get into, there's this strategy, there's this time duration you can trade, there's this longer time duration you can trade. There's all this information on social media. If somebody's just getting into the market and they see all these different types of strategies, different types of time durations, and they're a little bit confused about what's going on, what's some, to wrap things up, what's some advice you would give them?
I think when you're trading these for the first time, number one, stay small. if you have any size of an account, just start with the simplest zero DTE strategy, and what I would consider that is in the SPY, defined risk trade. Start with the butterfly. Sell 2 calls at the money, buy one $3 away, buy one lower $3, right? So you're basically having a butterfly with $3 wide wings on both sides. On any random day, you're probably going to pay between 50 cents and $1 for that. And you could make, right, if you're looking to take about 25 to 30%, you can make between 10 and 20 cents on that trade. 10, 20, 30 cents, and your risk is only the amount you paid. So it basically gives you a taste of how this market works without putting all your eggs in that market and worrying about losing it all. Defining your risk is going to be the key to that, because if you define your risk, you know exactly how much you can lose, you know exactly how much you can make, and an underlying like SPY, it's very liquid, so you never have to worry about getting a bad fill, and it's a small enough underlying where you're only risking between 50 cents and $1 a trade. So on any given day, your total risk could be $50, $100, and you could make about, $25, $50 on that trade if it's a winner.
In 15 minutes until the market closes, and I'm only up $6 right now, and I was actually just up about 50% profit of the credit received on the trade. But this just goes to show how fast and volatile these option prices can change on these 0 days options, these zero DTEs. I was literally just up $17, but now it's switching, because if you look at the price action, we're kind of grinding upwards, and we're kind of grinding towards the call that I sold. So we're gonna go ahead and get out and just see if we can even collect a few dollars for the trade. Now you can see I sold the Iron Condor, I sold the 411 strike, and then I sold the 408 strike. So we're gonna go ahead and try and close this trade out. So I'm gonna buy the one that I sold the one that I bought, and then buy back the 408 that I sold, and then sell back the 407 that I bought. We're gonna see if we can sell this for 30 cents, which would be $7, because I sold it for 37 cents of credit. Let me replace this. I might even have to collect even less, because we're kind of getting this late day rally. So we'll see if we can even get a fill. Well, I'll go up one more penny. And again, I could have sat in this. So we made $4 on the trade. And again, I mean, I could have sat in this until the end of day, but then I kind of have that end of day risk where it could be really, trading around the strikes that I sold. So we made a couple bucks on this trade. It pretty much ended in a scratch. But if I were to trade this again, I might go a little bit more directional. Again, this week I went neutral because of the choppy action we usually see before CPI news. And maybe next time I'll take the profit around 50% of the max profit. But it looks like with zero DTEs, it's something that you're gonna have to be paying attention to price action a little bit more, paying attention to where your break evens on the chart are sitting, and just being really mindful about order entry and how much you're sizing into these positions. Because again, these options expire at the end of the day. So if you buy options and they're out of the money, they're gonna expire completely worthless. So that's something to keep in mind. And if you're a beginner, make sure you just take your time, don't skip any steps, and follow the #1 rule: keep size small and don't push size until you feel comfortable. So if you wanna learn more about zero DTE options, be sure to check out these other videos, and we'll see you in the next vlog.